Welcome to this Finbot Insights Explainer. Today, we are dissecting the illusion of safety that is often packaged with high-yield ETFs. We will investigate the promise and indeed the peril of funds like Yieldmax's MSTY and WNTR to uncover what is truly happening with your investment capital. Our story begins with a number that is almost impossible for an income investor to ignore: a triple-digit yield. This is the promise that pulls in capital, offering what appears to be a perfect solution for generating cash flow in a portfolio. This sentiment is remarkably common. For many, the high payout is the only metric that seems to matter, but focusing solely on the distribution rate overlooks a far more critical measure of an investment's success. That measure is total return. It is absolutely essential that the promise of income be weighed against this reality. We must look beyond the advertised yield to understand the actual performance, which combines the cash you receive with the change in the principal value of the shares themselves. And when we examine total return adjusted for inflation, the data reveals a starkly different picture. Year-to-date, MSTY has delivered a negative total return of 5.71%. Its counterpart, WNTR, is also in negative territory at 2.30%. The high yield has not been enough to offset capital losses. Let's put this in concrete terms. A $10,000 investment in MSTY made earlier this year would now be worth less than $8,900. This is a significant capital loss, even after accounting for every single high-yield distribution paid out. Beyond the negative returns, both funds have exhibited extreme downside volatility. MSTY has experienced a maximum drawdown of over 35%. WNTR has seen a peak-to-trough decline of more than 39%. These are not minor fluctuations. They represent severe impairments of your capital. This brings us to the central paradox. How can a fund that advertises a yield north of 100% possibly result in a net loss for the investor? To answer this, we must dissect the underlying mechanics of these complex exchange-traded funds. These funds generate their distributions through an option income strategy. They sell derivatives, typically covered calls, on a highly volatile underlying stock like MicroStrategy. The cash premium they collect from selling those options is what is then distributed to you, the shareholder, as income. Now, remember that a fund's total return has two components: those distributions and the change in its net asset value, or NAV. The NAV represents the fund's per-share principal value. If the NAV declines, that loss directly subtracts from the income you receive from distributions. And here is the crucial point. A significant portion of these large distributions is often not profit at all. Instead, it is classified as a return of capital. This means the fund is simply handing your own money back to you, minus fees, which systematically erodes the fund's NAV and your principal investment. The scale of this mechanism is truly substantial. A recent Morningstar analysis found that of the $5.4 billion distributed by this fund group through April of 2025, a staggering $4.2 billion was simply a return of capital. This is a systematic depletion of the asset base disguised as income. This expert analysis from Morningstar pinpoints the fundamental issue. The options income alone is often not enough to support the huge distribution rates. So to make those payments, the fund must dip into its own principal, which erodes the NAV and creates a powerful illusion of profitability. What is fascinating is that this observation from a retail investor perfectly mirrors the expert critique. It demonstrates a direct, real-world understanding of NAV decay. The distribution rate is a function of the share price. So as the NAV falls, the dollar amount of the distribution is adjusted downward, yet the headline percentage yield can remain high, masking the ongoing capital erosion. The central conflict for you as an investor, therefore, is discerning the difference between a high payout and a genuinely profitable investment. The allure is the headline distribution rate. The reality, as we have seen, is often a negative total return, driven by the persistent decay of the fund's net asset value. This analysis provides a clear framework for evaluating these products. First, total return is the only metric that matters. Second, you must investigate whether distributions are classified as a return of capital. Third, recognize that the volatility of the underlying stock is a primary risk you are taking. And finally, remember that poor market timing can mean your actual outcome is far worse than the fund's reported returns. So, when a yield seems too good to be true, you must look past the marketing. If a distribution is mostly a return of capital, then the answer to the question, whose money is paying for it, is simple.
It is your own. If you found this data-driven analysis valuable, we ask that you support our work by clicking the like button and subscribing to Finbot Insights for more explainers like this one.
Please remember, this content is for educational and informational purposes only and does not constitute financial advice. Past performance is no guarantee of future results. Critically, you should not make investment decisions based on information you find on social media, and that includes this channel. Always conduct your own thorough due diligence before making any investment.